What are the 9 ways you can take advantage of the current market? The first one is starting with the basics, namely, when is the last time you've looked at your family budget comprehensively? If you go to the link in the description, you can access a free download for a family budget. You can type in your actual current budget. You can type in what it ends up being on a month-to-month basis, namely what you budgeted for. And then on a look back, you can see how you actually performed as a household. What this does is it helps you be aware of your spending to make sure that it's in line with your goals. The reason we want to start with this is we want to make sure that you can plan ahead. And this is fairly comprehensive, so don't be overwhelmed. But the goal is we want to capture all of your true expenses. And we'll talk about why in just a little bit. But here's the easy and free budget calculator you can download. Once you've put together your budget and you have an understanding of how much you're actually spending every month on the essentials, but then also the discretionary, and we like to include the discretionary, namely entertainment, eating out, travel, the luxuries in life, because it's often referred to as golden handcuffs, where we want to make sure that you don't end up with a housing payment you can barely afford, but then you're not able to do any of the fun things with you, your friends, and family that you're hoping to. So that's why we start first with the budget. The next important piece to note is we often can qualify clients for more than what their budget actually allows. So you might be able to technically qualify for a $600,000 home, but maybe they like to travel every other month, and this would totally eliminate that portion of their budget. Where let's fast forward 6-12 months, and frankly, they're miserable. They have a beautiful home, but they can't do what they love. So here is a debt to income ratio. So what that means is we look at how much you earn on a monthly basis gross. This is pre-tax earnings. So take a salary and divide it by 12. Or take your hourly rate and multiply it by 2080 and then divide it by 12. That's how many working hours there are in a year. 2080. 2080. So here is a handy debt to income ratio calculator that you can take a look at. So what you do is you end up typing in your income. You type in any other miscellaneous income that you earn. Then you type in all of those budgetary items. So just copy and paste over from your budget. You know exactly what's applicable in each of these boxes. Then when you click calculate, it tells you what your debt to income ratio is. We recommend no higher than 40%. That's about in that yellow zone there. So this calculator is free. The link will be in the description. Don't mind the ads here. We start here again because if you work so hard to buy a house, you go through the entire mortgage process, then you end up with a housing payment that limits you from the other fun things you want to experience in life. Number 2, please call me or a trusted local loan officer before you make large financial purchases. It is not necessarily impossible to make those purchases, namely a new car, furniture for your new home, and oftentimes there's special financing for these, which makes it even more tempting. We can strategize how to put this together where you can still come out ahead, but please call me first because each scenario is different. Here's the third one, maintaining leverage. In any negotiation, not just for a house, but in life in general, having a take it or leave it attitude is what increases your leverage in a negotiation. Namely, you could walk away at any moment. The problem for potential home buyers is you walk in a home and you imagine where your kids or your dog will grow up in. You start to visualize what that will look like, and then your heart starts getting invested. That's when you go around that corner and you become emotionally invested into the property, and then you can potentially weaken your negotiating leverage. So tip number 3, maintain leverage, preserve the ability to walk away. That way you don't talk yourself into a bad deal. Number 4, homeowners insurance. Insurance is usually often an afterthought, which is too bad because insurance is a product where you want to make sure you have the right insurance for when you need it. So we have a local recommended insurance agent that can write policies for all of Wisconsin. And he'll be able to provide to you education, as I do for my clients, advice, and then recommendations as if you are his own family for what policies you actually need. Sometimes a policy with him could end up being more than a policy you could find online, but it has the better and proper coverage so that when you need it, you have exactly what you need. Because by the time you need the insurance, it is too late. Number 5, there'll be a link in the description as well for this, scheduling a video buyer consultation. We can hop right on Zoom, and typically we do this once you're pre-approved. So we hop on these video buyer consultations so that we can help explain the nitty-gritty of how much you qualify for. But we'll double check and make sure that it's a payment you can actually afford relative to the rest of your budget and your financial goals. We cannot simply do this over a phone call, or at least it's much more difficult because these are complicated concepts to discuss. We will also do a screen share of the mortgage market. We'll explain what economic influences cause mortgage rates to go up or down. And we'll show you what your mortgage looks like and different rate options that you have. So there's a lot to cover, which is why we schedule a 45 to 60 minute home buyer consultation. Again, a link will be in the bio so that you can see what this looks like. Next one is keeping your perspective. The news loves to talk about how, yes, rates have gone up, but here is how the math actually shakes out. It is $8,479 cheaper to buy a house in November than it was earlier this year when rates were as low as 4.75. Here's how the math shakes out. The same property that would have been listed for $350,000 earlier this year most likely would have sold for at least $380,000, if not $400,000. Why? There was even less inventory earlier in this year, and people were terrified that these low rates were going to go away. So they wanted to capitalize on the market. They wrote a very aggressive and strong offer. The feeding frenzy and competition drove this hype, and then people were paying significantly more than the list price. Now that rates have gone up so much, the media is doing what it can to freak people out because that drives viewers and it drives clicks to online news articles. However, because people are scared off, look what happens to the sale price. Instead of a $380,000 sale price, it drops all the way down to $345,000. That's a swing of $35,000, at least in our favor now in November of 2022, relative to earlier this year. What does that mean for mortgage interest that you're paying? Yes, it is about $27,000 more in mortgage interest that you're paying over a 3-year period. However, remember that people overpaid $35,000 for their home not just 6 months ago. So the 3-year cost of a mortgage, plus if you over or underpaid for the same house, shakes out to be you save $8,479 by buying a house now when rates are higher because of the slap-in deal that you get on that property. Sellers are willing to negotiate in credits. They'll do a buy down. There's a product called a 2-1 buy down where the seller will lower your first year mortgage rate by 2% and your second year by 1%. This product is very advantageous for clients who are easing into a new career, or they're expecting income growth in the future, or they just want to ease into a higher mortgage payment. A 2% reduction year 1, 1% reduction year 2. For a typical Milwaukee property and buyers that we see, that's a difference of about $400 per month the first year and about $200 per month the second year. Having perspective like this and keeping your wits about you can really help calm your fears when the news tries to get you terrified. Number 7, having an experienced realtor. Throughout all of COVID, from 2020 through the end of 2021, there was a massive amount of real estate transactions that were happening. And so attracted to what seemed like easy money, loan officers came out of nowhere, realtors came out of nowhere. And now there are herds of inexperienced realtors and loan officers that haven't been, called yet from the group. And as this market becomes more and more challenging, we may see realtors and loan officers start to step off to the sidelines because the temperature is rising. So what that means for you is interview your realtor before you commit to working with them. Don't be afraid to ask some questions about what is the relevant experience. What does buying a house in this market mean for you? What do you think the future of real estate will look like? See if they're informed on the market. See if they have these data points handy that shows you that they are a market expert. If you would like a recommendation for a realtor that I trust, that I know will help take care of you, please let me know. Relative to your price point, location, all that sort of thing, I can pair you up with a realtor that's a perfect fit. Number 8, if it's a possibility that you will be buying within the next 6 to 12 months, it's a great time to check out your credit score. We want to make sure that your credit report is going to be accurate. And so annualcreditreport.com is a free service where you're able to order, it's called a tri-merge credit report. You'll see Equifax, Experian, and TransUnion listed. What does this mean? You're able to see what all 3 credit bureaus have on file for you. And often there is something incorrect where you're able to dispute this report and correct inaccuracies. Why does that matter? Your interest rate and the loan program you qualify for is contingent on having a higher credit score. Every 20 points your score is below 740, your mortgage rate will increase or the loan will become more expensive for you. So if you start on annualcreditreport.com, you can see what's on your report, make sure there aren't inaccuracies or things on that report that you weren't even aware of. Perhaps you paid off a medical collection or a non-medical collection and it's still lingering on your credit. In a recent change, zero balance medical collections no longer report to credit as derogatory, but non-medical collections are still reporting. Namely, a $200 bill that you owe to one of the telecom companies, not to name any names. Perhaps you move and then their records show that you didn't return a cable box. You'll eventually end up in collections for about a $200 to $300 bill because you didn't return the cable box. That collection will make all of your future credit more expensive because it looks like you're irresponsible. Let's get that sorted out now. Finally, number 9, what are your family's financial goals? Some people believe they need to do a 20% down payment or greater for some reason or another. Unfortunately, this just isn't true and often isn't our recommendation for many people. Here's why. Have you assessed what your family's financial goals are for the next 5 to 15 years? Namely, do you need to start saving up for a child's college education account? Are there big trips that you're excited about going on? Is your retirement account underfunded? And here's why it matters. We can structure your mortgage in such a way that you position yourself for success by leveraging your mortgage. For a $400,000 purchase, you could do a 20% down, or you could choose something like a 10% down payment. And what this report illustrates is the difference of your net worth in 7 years. If you do a 20% down payment, your equity in 7 years would be $234,746. This is accomplished in 2 ways. You've put $80,000 down already, and then the rest is mortgage amortization. You're paying down your mortgage, so you're gaining equity that way, and then also appreciation. This report simulates property appreciation, namely that the property will gain value over time. You see listed here a 4% appreciation. What I love to do for my clients is prepare custom presentations like this, where you can see exactly for your scenario, your price point, your down payment that you're considering, what would that net worth look like in the future? So this is based on 4% appreciation. So the home gained in value by $126,373. The loan balance decreased because you're making mortgage payments. So then you end up with a $234,746,000 net worth. Check this out. If you choose to do a 10% down, and then you invest the difference of what your down payment would have been, which would be $60,000, then it would grow all the way to $97,224. And so check this out. So then to recap, your savings balance, the difference between the 10 and 20% down payment would be roughly the $36,000 to $40,000 down payment that you'd be saving by not doing a 20% down. It would then grow to a total investment account value of between $97,000 and $100,000. So there'd be that much growth within a 7-year period. And this is based on a 6% rate of return. Check this out. This is the difference in your net worth, which does already account for the difference in down payment, right? You will be worth $60,000 more so long as you invest what you would have put in your down payment. As soon as you put in the down payment, that equity is locked up and it dries out, right? Where if you do a 10% down or a 20% down, the property is still going to appreciate at the same rate of return. You actually get a higher rate of return on your investment if you do a lower down payment, because if you only do a $40,000 down payment, you still get to enjoy the home value gain of $126,000. So you 3x your money in a 7-year period. That's better than most all other investments that I'm aware of, unless you're an investor on Shark Tank and the business knocks it out of the water. So to recap, item number 9, we can plan your mortgage around your family's financial future goals. And you don't need to do a 20% down, especially if there's something else you do with that money, such as invest it in an account for a child's college or for your future retirement. If you like the content here, please do subscribe, ring the bell, drop me a comment if you have questions. Otherwise, your next steps towards your home ownership journey would be to schedule a 15-minute call. There'll be a link in the bio. We could learn some more about what you're hoping to accomplish with your purchase, prepare a custom presentation as I showed on the screen, and really be intentional about next steps for your family.